Assalamu alaikum. Tesla's stock price continues to be one of the most controversial topics in the investing world. Bulls tend to think that it's still undervalued, whereas bears think it's ridiculously overvalued, and sometimes go so far as to compare it to the tulip bubble of the early 1600s in Europe. So where is the truth of the matter? Followers of this channel know that I've been a Tesla bull for a while now, and it represents around 70% of the practical Islamic finance portfolio, which is the portfolio I put together to follow the stocks that I speak positively about on this channel. Link to that portfolio is in the description, by the way, if you're interested in checking it out. Also, if you're interested in checking out the M1 Finance brokerage service, which I am a fan of and have been recommending for quite some time now, check out the link in the description below. It's a completely free service. It's available if you live in the United States. And if you use the link in the description, you'll be supporting the channel, and I really do appreciate that. A lot of people have been asking me, what am I doing with my position in Tesla in light of this recent massive run-up that Tesla has experienced? Am I still buying? Am I selling? Am I just holding my position? What am I doing? In this video, I'm going to answer exactly this question. Naturally, the right investment decision related to Tesla stock, or any stock for that matter, is going to be driven by the valuation calculation for that stock. So I'm going to start with my valuation for Tesla stock and walk you through how I got there. Tesla's sales revenue as of the second quarter of 2020 came from the following business segments. Automotive sales revenue represented 81% of Tesla's sales revenue. Automotive leasing revenue represented 5%. Services and other represented 8%. And by services and other, we're referring to non-warranty after-sales vehicle services, sales of used vehicles, retail merchandise, sales by Tesla's acquired subsidiaries to third-party customers, and vehicle insurance revenue. And then finally, energy generation and storage represented 6% of Tesla's revenue. The valuation for Tesla that I'm going to share with you is my bear case, meaning this is what I would consider a somewhat pessimistic valuation for Tesla. And the reason why I'm going to consider it my bear case is because I'm going to assume that Tesla only makes money from selling cars, meaning we're excluding Tesla's energy generation and storage business entirely from our calculations. So no solar panel business and no separate battery business, aside from what relates to the production of vehicles. And having said this, I think that Tesla's energy generation and storage businesses have the potential of becoming just as big as Tesla's automotive business, if not bigger. And so does Elon Musk, the CEO of Tesla.
I think long-term Tesla Energy will be roughly the same size as Tesla Automotive. The energy business collectively is bigger than the automotive business. Battery and solar will both be enormous. And they kind of have to be in order for us to have a sustainable future. And we've got a great product roadmap on that front as well.
The reason why I wanted to focus just on the automotive business is that if we're able to come up with a compelling case for an investment in Tesla, just using their automotive business and without considering their energy generation and storage business, if we're still able to come up with a compelling case for investing in Tesla under these assumptions, then I think an investment in Tesla becomes a no-brainer, at least in my mind. To estimate the value of Tesla's automotive business, we need to answer the following three questions. First, how many cars is Tesla going to produce? Second, how much is Tesla going to profit from each car that it produces? And third, what multiple of profit will investors be willing to pay for every dollar in profit that Tesla produces? First, let's start with how many cars is Tesla projected to produce. Currently, Tesla's guidance for 2020 is that it's going to produce around 500,000 cars. Depending on who you ask, estimates for the growth rate of Tesla vary between 30 and 50% annually. If you average the growth rate that Tesla has achieved annually since 2014, it comes out to around 60% annually. Elon Musk has mentioned numerous times that the aim is to grow Tesla at a rate in excess of 50% annually.
Yeah, I think a few years ago I said I don't know when it was, but a few years ago I said my estimate is that Tesla would grow at an average compound annual rate of in excess of 50%. I still hold to that belief.
So based on this, I think a 40% annual growth rate for Tesla over the next 3 to 5 years is a reasonable assumption to use in our valuation model. The second question that we have to answer with regards to valuing Tesla's automotive business is how much in profit will Tesla earn on every car that it sells? I expect the profit margin that Tesla will enjoy from selling its vehicles will be much higher than the profit margin that internal combustion engine manufacturers have ever had. This is because Tesla doesn't only sell a car, it also sells the software updates on that car, most notably the full self-driving feature. And the margins for software tend to be sky high. And Elon Musk has alluded to this high volume, high margin earnings potential in previous earnings calls.
Yeah, I mean, the thing that's really going to, I think, probably just have a profound effect on our financials is high volume and high margin, obviously. And that high margin part comes from autonomy. So do people buy the full self-driving package or not? And do they buy it worldwide or only in certain places? As we get closer to full self-driving, that's just going to become more and more compelling. So that's, from a financial standpoint, that's the real mind-blowing situation, is high volume, high margin because of autonomy.
Not to mention Tesla Insurance, which I think is going to further add to Tesla's margins. So what profit margin can we expect from Tesla? ARK Invest has a pretty thorough analysis of what they expect this profit margin to be, and they rely on Wright's law to come up with an estimate for how the cost of manufacturing a Tesla vehicle is going to decline over time. For those who are unfamiliar, Theodore Wright basically hypothesized that for every doubling in production, there was a fixed cost reduction that was associated with it. So he was observing the manufacturing of airplanes, and he observed that every time the volume of production doubled, the cost of labor would reduce by 10 to 15%. And this is because of experience that is gained and efficiencies that come out from that added experience in the manufacturing process. And Wright's law has been able to successfully forecast the cost decline in many different technologies over many different industries. Now, as shown in this chart that's provided by ARK Invest, Tesla's Model 3 already has demonstrated cost declines in line with Wright's law. The gray dots on this chart are where Model 3 costs have been, and the solid black line represents where Wright's law predicted it would be. Now, if costs continue to fall in line with Wright's law, ARK Invest's model suggests that Tesla's gross margins could reach 40% in the next 5 years. If this is true, we're looking at an EBITDA profit margin of around 25%. Based on this, if the average price of a car sold by Tesla is $40,000, then the average profit that Tesla earns from every car is going to be around $10,000. So now that we have a forecast for how many cars Tesla is going to produce based on the growth rate and how much it's going to earn per car it produces, let's talk about what is a reasonable forecast for how much investors will pay for every dollar in profit that Tesla earns. The company that I think was most analogous 4 or 5 years ago to where Tesla is right now is perhaps Amazon. I say this for a number of reasons. First, Amazon is a company that for the last 10 years, in fact, for the last 20 years, it has prioritized growth over profit. And this has been the strategy of Tesla since its inception. It's always trying to expand into new businesses, new endeavors, reinvesting a large portion of its revenue back into the business because they are prioritizing growth over profit. So I see Amazon and Tesla similar in this regard. And I see a similarity in that Amazon has managed to build a very substantial moat around its business, which is a combination of Amazon's technological superiority over a lot of its competitors and its very robust logistics infrastructure. And both of these areas are areas where I see Tesla head and shoulders above its competition currently, and I think that this gap between it and between competitors is actually going to increase rather than decrease in the years to come. With regards to Amazon, since achieving consistent profitability in 2015, the lowest PE ratio Amazon traded at was around 75. Currently, Tesla's PE ratio is close to 1,000. I expect this PE ratio to come down with time, but I actually think if Tesla remains as innovative and maintains the growth rate that it has achieved in prior years, I think it's actually reasonable to expect Tesla is going to continue to trade at an above 100 PE ratio for the next 3 to 5 years. Having said this, I know that the market is in the midst of one of the longest bull runs in history, and this has got to end at some point. So let's assume a PE ratio of 50 in the year 2025. So in the year 2025, Tesla is trading at a PE ratio of around 50, which I think is probably going to be conservative. But why not? Let's be conservative. Okay, so now we have the 3 assumptions that we needed to value Tesla. The first is that we think it's going to maintain a 40% growth rate annually over the next 3 to 5 years. The second is that we think it's going to profit around $10,000 on average per every vehicle sold. The third is that our expectations for the multiple that investors would be willing to pay for Tesla in year 2025, for example, is going to be around 50 times. Now, these are my assumptions. If you think any of these assumptions are off base, then please do let me know in the comments. I'd love to hear any feedback you may have. So based on these assumptions, a 40% growth rate means in 2021, they're probably going to produce around 700,000 cars. The year after that, it's going to be closer to 1 million. And then finally in 2025, we're looking at 2.5 to 3 million cars produced annually by Tesla at a profit per car of $10,000. This gives the total Tesla profit a value of around 26 to 27 billion dollars in 2025. If we look at the value of the company at a 50 times multiple of profit, we're looking at a $1.3 trillion company. And I assumed regarding number of shares, a 5% dilution of those shares every year. So the number of shares currently is around 950 million, but I assumed that in 2025 it was going to be 1.1 billion. So this gives the share price in 2025 a value of $1,164. Today, that share price is at $370. So you're looking at a 3x return on Tesla, even at today's price, in the span of 3 to 5 years. And keep in mind, I am only valuing their automotive business. And also keep in mind that the S&P, if you look at the last 50 years, returned around 8% annually. So you need around 9 years if you're just following the market to double your money. And here with Tesla, within 3 to 5 years, there is a potential for a 3x return. So I'm expecting Tesla to outperform the market by a wide margin. And again, I think the numbers that I showed you are on the conservative side. And I say this for the following reasons. Number one, as we mentioned, we're only taking into account Tesla's automotive business. We haven't said anything about energy generation and storage. We haven't said anything about Tesla batteries and Tesla solar panels. Number two, we've completely neglected the possibility of a ride-hailing service that Tesla rolls out after it has the full self-driving working in its cars. Now, Elon Musk has predicted that once full self-driving is working and the ride-hailing network is functional, the value of each Tesla will probably go up 5 times.
And right now, by far, FSD is just overwhelmingly the most important thing. I think the upgrading of the fleet to full self-driving, essentially with an over-the-air software update, may go down as the biggest asset value increase in history as a step change. Maybe there's something bigger, but it certainly would be one of the biggest. I can't think of anything bigger. The step change to full self-driving, depending upon how you calculate it, is probably worth at least $100,000 per car.
After all, instead of working on average 12 hours a week, when you add a Tesla car to the ride-hailing network, you're going to get 60 hours of utility from that car on average every week. And this would cause Tesla's price to really skyrocket, in my view. So needless to say, I am holding on to my Tesla shares for the foreseeable future. Now, what you do with your Tesla shares, if you have any, or whether you buy shares or not, is a decision that you have to make for yourself. Make sure you do your own due diligence. I'm not your financial advisor. So make sure you do your own research and come out with your own conclusions. What's in this video is what I'm going to do. Now, if you're wondering how I deal with a massive run-up in the price of Tesla stock when those run-ups happen, like what happened prior to the recent 5-to-1 split that Tesla stock experienced, my policy is very simple. Let's say I have the target percentage of Tesla in my portfolio set at 70%. And let's say the stock price runs up a lot and it reaches 74% of my portfolio. If I need to take money out of my portfolio, I just sell enough shares of Tesla to bring that percentage back down to 70%. If I'm not pulling any money from my stock portfolio, and I rarely ever do, then the next time I buy, if Tesla's at 74% of my portfolio and my target is for it to be at 70%, the next time I buy, I just buy less Tesla stock so that the portfolio is reverting to the target weights that I set for it whenever I am selling and whenever I am buying. That's my strategy. And if you have an account with M1 Finance, this is done automatically for you, which I think is a real advantage that M1 Finance has. So again, if you're in the United States and you're looking for a brokerage to use, I'd highly recommend trying out M1 Finance. If you use the link in the description, you'll be supporting the channel, and I really appreciate that. And I should mention, in terms of halalness, because after all, the name of the channel is Practical Islamic Finance. In terms of halalness, I am very comfortable investing in Tesla stock. I've covered this matter in previous videos, so check those out if you're interested in my opinion on that. I hope you found this video beneficial, and if you did, leave a like, subscribe for more content, and until next time, make sure to take care of yourself. Assalamu alaikum, and peace be upon you all.